Good evening to each and everyone present here today. After an insightful episode 1 of Power Series, where we unveiled top, mid, and small cap stocks, our founder Dr. Mohit Batra and CIO Mr. Sunil Damania are back with an action-packed Q&A session to address all your queries today. Feel free to drop in any questions you have in the box below. Over to you, Dr. Mohit.
Thanks a lot, Jason. Let me start by wishing all of you a very happy Holi. Wishing you and your family a joyful life full of color. The only color we should avoid is the color of red, as they call it on a Hindi song, popular song, which Sunil reminded me, "Ye laal rang kab mujhe chhodega." We hope that you put all the colors, but you wash the red color as soon as possible. And that is our genuine hope. Wishing all of you a very happy Holi. Please wish everybody from your side. And with that note, let's start the proceedings. I'm not going to spend too much time because today we want to this session is more about the Q&A, because I know that you have a lot of questions. Just to recap, because some of you may not have attended our Saturday's webinar where Sunil and me had gone together and we had told you what our view in the market is and given a lot of insightful numbers. And then we had also given some selection of stocks which we personally feel on a long-term basis, they look pretty decent to us at the current levels and with their business plans. So I'm not going to deep dive into that. But having said that, for people who are coming in new to this particular webinar and they missed the last Saturday's webinar, plus we had sent the recording in case you missed that also, I will spend 10-15 minutes to summarize our last webinar's hypothesis that we had taken. And then we will, within 15 minutes, we'll get on to the Q&A stage and we'll try and cover as many questions as possible. With that note, let me start the proceedings. I'm not going to read the whole disclaimer, but this webinar is only for knowledge and education purposes. If you're taking any investment advice basis out of this, please make sure that you consult your certified investment partners and make sure that you realize that equity investing is, construes high risk. There is no guarantee of returns, and equity related investments obviously involve a high degree of risk, and users should not invest unless they can afford to take that risk. Obviously, this is the disclaimer, and we all know this, but we should strictly follow it. We had also done a series of questions that we asked, or rather poll that we asked our investors. There were 3 questions predominantly that we wanted to ask our investors. We, because of shortage of time last Saturday, we did not share the results of that. I'm happy to share the results today. These are poll questions that you answered last Saturday. Let me pick up the first question that we'd asked you. How much have you lost on your equity portfolio in the last 1 year? Now, majority, which is 32%, are saying 10 to 20% negative. The next is 22% are saying 20 to 30% negative. More than 30% is 9%. 23% are saying that they're still in profit. And 14% are saying that they are in the range of 0 to minus 10%. So majority over 50% are typically, if I were to see, is minus 10 to minus 30% range, which is almost 54%, and the remaining are split across categories. But the 23%, good job done, because you're also in profit. Maybe this profit is because you've taken cash calls or you moved to the better companies, large caps, but it's a very well done job in the current markets if 23% of our investors are sitting in profit. The second question that we had asked is, how much did you withdraw from the markets recently? How much did you withdraw from the markets recently? I'm really happy to see this number, which is 0%, which is majority of the users, which is 58%. If you see 0 to 20% is the next category, which is 27%. 20 to 50% is 9%. 50 to 75% is a minuscule 3%. and people who've withdrawn almost fully, which is 75% to 100%, is a category which is 3% of the investors. So a lot of investors are still in the 100 to 80% invested range. If I were to combine 58 and 27 out there, we're talking about in excess of 70%, which are typically still invested at least 100% or at least 80% of what they were invested. The final question that we had asked you is, what do you think will be the return of Nifty as per your expectations or as per your calculations or your educated guess, I would say, in the current calendar year? Optimism is there, which is great because if you see the highest categories above 10%, which is 39%, 0 to 10% was 36%, negative category of 0 to 10% is 17%, and people who are talking about more than 10% correction in this calendar year is 8%. So again, if I were to look at positive versus negative, you're talking about almost 75% of the investors who are in the 0 to 20% range or 0 to more than 10% range. And we have 25% of investors who are broadly negative on the market, which basically means that they're anticipating a further correction or maybe ending the market or ending the calendar year in a negative. That's the broad poll results that we had done. It gives us also a flavor of how you're thinking. Now, I'm going to quickly summarize what we presented that day so that we can set a context or refresh your memories before we start the Q&A session. Before I go there, we are at the end of financial year. We've done a fiscal offer, which from next fiscal, we are going to increase the prices of the package. This offer is only applicable for people who are on this webinar. This is not available on the website. Anywhere that you go, you will not find this particular offer. It's 15,999. You are typically at a 1-year Mojo One subscription, but you get a special 2 years free. So this 15,999 becomes a price for 3 years. This is one of the lowest offers, rather the lowest offer that we've done ever in the last 10 years. The prices will increase, and if you want to subscribe, you will find the link below your YouTube channel where you can click on it and renew it and renew your membership. You can buy this multiple times also because you're getting 3 years in just 15,999, which is something that we've never done before. The lowest offers we used to do was 14,999, but that was way back. But our majority of the offers have been typically in the 22,000 kind of a range. So 15,999 for 3 years is the offer. You can click and you can subscribe to this. As I said, this is not available on the website. With that, let us summarize what we presented last Saturday. Quickly, I'll go through it so that you refresh your memories and we can get back to our Q&A session. A quick recap on the fall on market. The slide has been updated on 7th of March, but broadly we are there. Sensex has corrected from its high 14%. Nifty 50 has corrected 17%. BSE 500 has corrected 17%. Mid caps have corrected 20%, and BSE small cap has corrected close to 22%. So the carnage has happened across, but obviously it has happened less on the large cap category, which is typically 14-15%. But from mid cap to small cap, the numbers are -20 and plus, -20 being mid cap and -22 being the small cap category. Very interesting data point out here. The 10-year average price to earning ratio of Sensex is 24.3. We are today trading at 20.7, so well below the 10-year average. Nifty 50, the 10-year average being 23.5, we are trading at 20, well below. BSE 500, the 10-year average is 25.7. We are trading today at 22.4, well below. BSE mid cap 37.2, the 10-year average. We are trading closer, but I have a point that I'll later make on the mid caps at 31.7. And BSE small cap 39.2, the 10-year average. We have removed the COVID year because that was an exceptionally loss-making year for small caps. But otherwise, if you see on a 10-year average or rather 9-year average, I would say 39.2 versus where we are today, which is 27.9. So there's a large PE correction or valuation correction that has happened, which has got across all categories from Sensex to small caps, well below their 10-year average. Does that mean anything? We will come to that. Now, if you were to see, we've done a little bit of analysis out here of certain falls. 2025, which is the recent fall. 2022, we've taken 2020 was a COVID year. We've taken that also. October 2018, we have taken, and 2016, we have taken. Fall in Sensex currently is 15% versus 22 was 16.8. March 2020, COVID year, was almost 40%. October 2018 was 14% and 22%. When it fell and how much it took time to come back to the same level is the third column, which you say days to recover. That it took time, how much time it took to come back. So in June 2022, when we fell by 16.8 odd percent, we took 147 days to come back, right? Similarly, in March 2023, it took us 231 days to come back to that same high. October was 158 and Feb was 417 days. We are already 162 days in the recovery mode, which is from when we fell from the high, we are already at 162 days if you consider March 2025. The PE that we were trading at, which is 25.2, has dropped to a low PE of 20. Similarly, if you see in June, we were trading at 31 PE, which dropped down to 21. And you will see the PE drops out there. In March, 26 dropped down to 15.7. March, I think 2020 has been an exceptional year. We can all agree to that. But if you see, typically the PE corrections are typically in the range of when you come to 20s or 21, 22 kind of a range, that the PE that it hits the PE of low from the all-time high, whatever that number may be. But there is a resilience at 20 PE that we see across markets or across various categories that we see out here. Now, if you look at the bottoming out phenomena, if you see typically the Sensex, and this slide is more pertaining to Sensex. Sensex typically bottoms out at around 20 PE, right? I'm going to come back to that revisions slide in terms of where we are today so that you don't lose the numbers. But just to get the number mentally in your head, Sensex typically bounces back at a 20 PE is what we have seen historically. Mid caps typically bounce back at a 20 to 22 range. Mid caps typically bounce back at a 20 to 22 range. And small caps typically bounce back at a 30 kind of a range, right? Because if you see PE at low, we are today, even the PE at high that was in March 2025 was 36.4, which was actually lower than PE at low of various falls. If you see June, the PE at low was 31. If you see December 2016, the PE at low was 66. And if you see Feb 2016, which was a steep correction as well, the PE at low was 36.5. Our PE at high this time, when the markets in September started correcting, was 36.4, which was actually kind of a low. So, a lot of people talk about higher valuations of small caps and all. I'm just looking at historical numbers. I'm not commenting on what will happen in the future. But if you look at historical numbers, the number at which the PE was trading on small caps was actually at high in September 2024, was actually well low in some of the years when the market fully corrected. So if you were to kind of now look at consolidating of all of this data, what we are basically saying, PE today at 20.7, average bounce back is typically, as we've seen historically, history may or may not repeat. These are just data points for us to anchor our thought process somewhere before we get into the Q&A. But if you see Sensex, the current PE is 20.7. What we've seen over the last 4 or 5 corrections is that it bounces back at 20. So whether it's in range, answer is yes. Nifty 50, we are currently at 20. The average to bounce back historically has been 21, 22. Whether we are in range, the answer is yes. Now, interestingly, mid cap today is trading at 31.7. The average bounce backs that we've seen, or fall and then bounce back, and average lows that we've seen, and the bounce back that happens is 20 to 22. Are we in range? The answer is no. Mid cap still look to be pretty expensive out there as compared to the falls that have happened across other indices, including the small cap. If you look at 27.9, where we are today on small caps, the average bounce back is 30, so we are below the bounce back. Is it in range? The answer is yes. So what the data tells us of the historical events that have happened is that barring BSE mid-cap, we're broadly in the range. That doesn't mean that the bounce back is going to happen now, but we are broadly in the range of bounce back. There are a lot of market elements, global elements that play out to have this kind of a bounce back happen. But are we in the range? The answer is yes. If the bullet gets fired, it's going to hit. The answer is yes, apart from mid cap, which is still not in the range. Can it bounce back at this level and at 31.7? Answer is maybe. Yeah. So, but historically, what we've seen is that mid caps typically need a further correction and further more caution because it's still trading very high as per the historical falls that we've seen and the current PE. Small caps falls the most. It takes the longer time to recover as well. For all my friends who think that small caps will recover the first, the answer is an absolute no. You will have the rally first in large, then mid, and then it will go percolated down to small cap. If you've, historically, if you've seen the average drop of Sensex has been 17.9%. We've dropped so far 15%. Mid caps has been 18.4%. We have dropped now at 22%. Small caps historical drop has been around 20.4%. We've dropped around 26%. Average time to recover is quite similar, right? Average time to recover is quite similar. If you see Sensex is around 230 odd days. We are at 165 already, 162 covered. Mid caps is 209 days. We are 165 covered. Small caps started correcting later on. So, average historical we've seen is 278. We are 84 covered. So there may be some kind of a delay of, upward movement of small cap that we come. And that is very sensible because when your FI party will start again, the large caps are the ones that will move first. Then you'll percolate it down to mid cap because the retail sentiment will take a little time to come. And then, once the retail sentiment typically takes over the small cap, it takes that amount of time also because of the huge volatility and the fear of, again, losing money. Now, obviously, CAGR, what happens on bounce backs? When the bounce back actually happens, typically what we've seen is Sensex has delivered a 53% gain on bounce backs. Number of days the rally sustained was 697 days, and the CAGR was closer to 22.5%. Mid caps, the number of days that the rally sustained was lesser, which is 504 days, but the CAGR gains were much higher, which is 56%. And small caps also very similar to mid caps. The number of days the rally sustained was 550 days, and the CAGR gains was 60.1%. Drawdowns and volatility is what we understand, and what we need to understand is if you look at the 10-year returns and the volatility, obviously, as you go down the market cap, the volatility increases and so does the return. It's a typical risk reward, paradigm that we always know. 10-year return, Nifty 50, 10%, BSE Sensex 10%, BSE 500 now 11%, mid caps 14%, and 15% for small caps on a CAGR basis. If you see volatility 1.04 to 1.18, and if you see drawdowns, massive drawdown increases once you go down the market cap cycle from a 38% on Sensex to almost a 56% for the small cap category. So where do we see the bottom? We personally feel that we are closer to bottom on large cap. We also feel that we are similarly closer on small cap. We personally believe that mid caps can still get further downsides out there. We feel that we are 3 to 4 months away from that catching that bottom on the mid cap side, but it may be good time that we start looking at large caps and very, very cautiously. I would say very, very selectively and cautiously, because that rally is not going to come so soon on small cap, to start looking at selective smaller companies. They may take time. They may be a long-term call. They may not have the impact of immediate liquidity if the FIs come in, but you can start building up smaller positions out there. So we are closer to bottom with around 5-10% at maximum drawdown further on large caps. We see that there can be up to a 15% drawdown further on mid caps. And that may take another 3-4 months. Volatility will come in. All of these numbers, I would just tell you that they're all under a disclaimer, because this is a house view. We can go completely wrong on this as well, but this is our educated guess, nothing more than that. And small caps, it looks like they may not fall much more, but again, stock specific sense should prevail out there. What we had also done is that we had presented an allocation strategy. If you're a large cap investor, one can start investing now. If you want to play conservative, maybe with 2 or 3 installments, mid cap investors can wait for some time, and small cap investors will have to make very, very strong selection. And please depend on our scores, because our score considers all of this. So please depend on Mojo score. Do not take hearsay calls. You will start hearing now in the next 1 month, a lot of people starting to talk about buy this stock and buy this stock, 30% toota hai, 40%, 50% toota, and all of that stuff. Please be fundamentally very sound and check and make sure that you check the scores, you check the hypothesis, you check the thesis on Markets Mojo, because that's a fundamental curve that can come into your knowledge. We had done some stock selections. We had told you what we like, although this is again under a strict disclaimer. We don't do stock specific discussions on webinars, but we said what is it that we personally like as a personal intervention. If you were to do like the stock of the week, when we do analyze companies on a personal basis, we did some bit of a personal hypothesis out here. Almost all the companies, barring 2 companies, are hold. In this, SBFC Finance is a hold and Swaraj Engine is a hold. Otherwise, all are buys or strong buys on the system. In the large cap, we had selected Bajaj Finance, Bharti Airtel, Dixon Technologies, Kotak Mahindra Bank, and Mazagon Dock. We had given detailed rationale for the mid and small caps in the last video. I would not go down and do that again. If you want to see that, please look at the recordings of last Saturday that we've done. But in mid and small caps, we had selected Avanti Feeds, AstraZeneca, SBFC Finance, Swaraj Engines, and Taj GVK. Just to finish, 15,999, get 1 year plus 2 years free, limited offer, prices to increase soon. The link is the only place where you can get this price, not on the site. The link is available on YouTube. Please make sure that you subscribe as soon as possible. And otherwise, then when the price increases, we get a lot of pressure from you to give us the old prices. Those will not be available. With that note, we can switch on to Q&A immediately.
Okay, I'll start off with this first question by Balasundaram. Hi, Mohit and Sunil. We see Morgan Stanley believing that Sensex can reach 1,05,000 by December 25. I would like to hear separately from Mohit and separately from Sunil what they think Sensex will go out by December 25. Just give your gut feel. Don't worry, Mohit and Sunil, we won't hold on to it.
मोहित सर आप जाइए पहले.
I don't believe so that this feat can be achieved by December 2025. I personally feel that there are some fundamental issues that are there. The corporate India, growth has slowed down. If I were to see the trend of the last 2 quarters, euphorically, what people may be talking about is fine, but I personally feel that a double-digit growth this year is at best that we can look at in terms of the index growth. But I'm definitely not of the opinion that we'll have that feat achieved at least in 2025. As I said, my hypothesis is purely fundamental. and purely looking at the last 2 quarters of the corporate earnings that I've seen, I think it's going to take us some time.
So maybe I think I'll just give my view actually. So, I know, sir, you will not hold us responsible, but others will definitely hold us, because every time what I face, whatever we make prediction, if it doesn't happen, people just pounce on us. अरे तुमने तो ये बोला था, क्यों नहीं हुआ? Kind of stuff. So that's what normally happens with us. Going back to where do we see the market? If you go back to my equity outlook 2025, we did mention that what is the probability of returns that we can expect in the market in 2025. And if you go back there, we did mention that large cap should do better than the mid and small cap. And see, we said the Sensex or the Nifty, the broader market can give near about 10 to 20% return with the 55% probability. Between 0 to 10, we said 25% probability. So we are still bullish on the market, because 80% we believe that market can give anywhere between 0 to 20% return. And we continue with that probability. Only 10% probability that market will close in the negative in 2025. Now, one thing we must, and of course, someone yesterday asked me about a very famous investor making a prediction about, in next 5 years, we are not going to make any money kind of a stuff. I think we are forgetting one basic fundamental thing. And that basic fundamental thing is that in last 10 years, we have not seen any substantial rally. If you look at the CAGR returns, either Sensex or Nifty is somewhere in the region of 11%. Something in line with the what we call maybe the inflation, nominal GDP kind of stuff. So market has not run little ahead of the fundamentals in that sense. If you look at the 10 years period. So my sense is that yes, market will give positive. Now what level it closes and so on and so forth, I give you numbers, you play with that numbers and you figure out what level we should be. But remember, market should give anywhere between 0 to 20% return in 2025. The most probably range would be 10 to 20%.
Can I just get the screen, please? Have I got the screen?
Yes, Mohit.
Sorry. I'm going to share with you an innovation that we're doing, which hopefully we'll take it up on the site soon. What we've done is, consolidated BSE 500 as one company and made a CFT score, which is a quarter-on-quarter updated score. So if you see, and this is a 2019 odd score, right? So if you see the first graph, and then we have a technical chart as well, and we have, combined as well. We are doing a lot of innovation out here. We are also doing sector level stuff that, shortly we will start including it on the site, which will kind of give us 2 levels above the work that we do today only on the stock level. But interestingly, just wanted to show you this of my cautiousness out here. If you see the CFT, if you see the green line is a CFT and the blue line is the price movement. If you see now, barring 2020, where the CFT came to minus 5.21, the CFT is the current financial trend, as we call as quarter-on-quarter result trend of BSE 500 companies, right? So very clearly, if you see the top was somewhere in 2022, 12.16, and it remained in that range, 10, 12, and so on and so forth. But if you see the CFT somewhere in September, where typically the fall started with a little bit of a price lag, which always happens, and it was 7. And if you see the CFT has kind of dropped drastically at a 3.8 today, and you'll see, obviously the price drop has been substantial along with that. So we always tell you that fundamentals and price will mirror sooner or later, and this is kind of mirrored in this particular example very steeply. There are certain euphoria periods as well, like 2023, if you see broadly speaking, where the CFT was quite flat for the BSE 500, 10, 11, but it was not correcting. And the prices, obviously kept moving out there. But there is a steep correction on fundamentals that we've seen here. towards the current quarter. So interestingly, next quarter will be very interesting to see whether the CFT score improves for BSE 500, and then obviously we're going to make all of this live for you guys to start looking at this. We've got the technicals as well. I don't want to dwell deeper into this. We have to go straight on the agenda of Q&A, but I thought I'll just give you a rationale behind my caution at least.
Okay. Moving to this next question by Mayur. Hi, sir. Who makes profit or loss in this downfall? Is it the FI or retail investors?
Well, this question is for me.
Yeah, it's open to the panel.
I think my personal feeling is that everybody makes loss. I think FIs have broadly done a lot of profit booking. And obviously, the valuations that we were trading, and we obviously, I keep telling you this, but we came wrong last year, and you guys know that we came wrong because we were very early on in telling you that the valuations are high, and it's kind of sustained for 6 months, and we look pretty bad out there. But when the valuations are so high, profit booking is bound to happen, which is something that happened from the FI side. And obviously, retail sits on hope and greed because, and I'm not talking about MarketsMojo users, but I'm talking about broadly the F&O market, which still, money making became very easy. So if I talk fundamental investing, people used to say, हम तो एक महीने में 23% बना लेते हैं. We to make one month only at 20%. So what are you guys talking, right? So when that kind of a thing comes, that that froth is so big out there. So basically, who makes money and who doesn't make money is all dependent on the smartness at which either you exit at the right time or you stay invested. A lot of people who get out or have gotten out from September to March may be rejoicing today because loss come ho gaya. But I'll tell you, you will be the most susceptible of not getting in when the market rebounds. So I think the story is not over, point-to-point story. I think people who stay invested and stay patient and still have the belief will ultimately make money. But people who act too much, either they do get out of the market and say, oh, let's do profit booking because they take their own cash calls and all the stuff, they tend to lose. But there's no firm definition of who makes money and who doesn't make money. Yeah, I think the FIs move the market, so they have a bit of an advantage to move in first and move out. Today they are getting handsome valuations to move in back on the large cap side, and that rally is bound to happen. But I think patient investors are people who typically make money. Fundamental investors, cash delivery investors are people who make money. People who stay invested make money. People who move in and out of the market have moments of happiness, moments of relief, but ultimately they will not end up making money.
So maybe I can just give an answer to that. So when market goes down, everyone loses money, whether it's in retail investors or FI. And I'll explain you how and why it happens so. What percentage of FI have sold in the market? What is the holding? They have near about 78 lakh crore total investment value as of 31st December 2024. The data for 31st March 2025 has not yet come in. Of course, there are some data available in NSDL, but let's take it, this is 78 lakh thousand crore. When this, how much they sold? They sold about 3 lakh crore. So what percentage of 78 lakh crore, 3 crore, basically 3 lakh crore accounts for? Very minuscule. But by selling that, there is a mark to market on that 78 lakh crore. Isn't it? And they must have lost bigger amount. Now come back to the Indian retail investors. Their total holding would be near about, I think if my memory serves me right, is 48 lakh or 49 lakh crore total. Retail investors, typically that includes HNI and other stuff also. I did make presentation on that. I'm not able to recollect what the value was. So they also lose money because no one, see, there will be some case where you would get out of a company, may not reinvest that portion of the money in the market because you think that market may go down. But what happens to the stock that you're anyway holding not got out? So sometimes, you feel lucky or you feel happy that 100 rupiya tha, mera 20 rupiya maine bech diya. You feel happy over the 20 rupees. But you forget that you have another 80 rupees which is lying, which is basically giving mark to market kind of a stuff. and that really hurts that kind of stuff. So in the downward market, everyone loses money. The only guy who makes money is a short seller, basically, who basically has a very bearish view on the market and has that. But FII, I'm not sure they are enjoying this fall in the market. Very much doubt. I think they are enjoying this. So in a way, the bad market basically hurts everyone equally bad, depending upon what kind of exposure you have in the market, and that basically decides who basically lose more money in the market.
Okay. Moving to this next question by SS Namdari. Sharp price movements are caused by some events or news or rumors. They may be traps or opportunities. What criteria should be used to check whether those movements are beyond reasonable limits?
So, like when you say sharp price movement,
We had one classical incident happen a couple of days back with one of the private sector bank, and someone asked me yesterday that Warren Buffett said there cannot be only one cockroach in the kitchen, there could be more, and kind of a stuff. When sharp movements happens, and if it remains so, whatever the management say, there has to be something wrong with that company. We have seen that happening with 1% beverages. Management came on TV channel, everything is fine. One of the largest, the most loved, the fund manager in the country is invested in our company, everything, and then today the company is delisted. DHFL, another classical example, 50% fall in September 2019. So when there is a sharp price movement, and if the market does not listen to that explanation, remember that there is something wrong. And we have seen Yes Bank, we have seen Wakrangi, we have seen PC Jewelers. I can go on talking about names, on this one. So the simple formula, Bhav Bhagwan. If the collective wisdom of the market says that if the script has fallen and refuses to bounce back, assume there is something wrong with that. And the history suggests so. Am I right? There are many examples that which say so. So that is a trap. Never got. And in fact, Mohit made a very nice statement. I don't know whether how many people you observe that. He made a statement in his opening remarks, say, don't get by the company which has gone down by 20-30% and buy that company. I think that is the biggest trap, because first you find out why that company has gone down. There is a change in the fundamental story of that company. And if the answer is yes, please get out of that company. It's a trap for you. It's not an opportunity for you. But there is no logical reason for a company to go down. In the public domain, no corporate governance, management is quite steady. There is no change in the senior management. So you look at the IndusInd Bank, there were some instances which it's all there in public domain. I don't want to say. Just before the result, CFO resigned. So when you start connecting the dots, you get a lot of picture clarity there. And then eventually what happened. Am I right? So I think be careful with this. So this market gives you enough indication whether it's a trap or opportunity. Sometimes because of our human bias and so on and so forth, we don't want to see. We basically keep applying our own logic despite market signal is giving boss this to trap hai aapke liye. That's where you need to be very, very careful about this one. So when there is a sharp price movement and market is not willing to listen to the management explanation, it's a trap.
Okay. Moving to this next question by Venkat Ramu. Dear Mohit, please give your view on US, which is singled out against Europe, Japan, and many other countries. In US economy, is it hit? Will it have an impact on outside of the market also?
See, US economy will have an impact. There's no doubt about it. But it's very difficult to read Mr. Trump, whether he's posturing or he actually means what he says, because there's been a lot of dilly-dallying on the decisions on the calls that he's taken. He sometimes announces something, then he withdraws it back, then he announces something, then he withdraws it back. But if you look at today, where UK, the whole of Europe and Canada coming together and saying that we are going to retaliate, is not so easy to implement whatever he wants to implement out there. So there is a lot of posturing that is happening, and obviously he's also losing the same investor confidence that were the investors who put him on the throne. So he must be cognizant of all of those facts. So the kind of things that he's trying to implement are not very easy to implement because it kind of shakes up a large ecosystem that has been working for a while. So I think we should all wait and watch for all of this. I mean, classical example is I think a couple of days back, Nasdaq was down around 4%, and S&P 500 was down closer to 2.5%. But that day, actually, Indian markets closed in green, so or flat. But we were not down that particular day. So I'm not saying there's any kind of a decoupling out there, but I personally feel that there is a classical wait and watch we need to adopt out there. If they implement something drastic, will that have a global impact? The answer is absolutely. I think a lot of global impact can happen. There can be very sector-specific impact that can happen to India, which is on a fundamental level. I'm not talking about on the levels of market sentiment, which will get impacted, but on a fundamental level, in terms of our export items that we have to the US, whether it is handphones, electronics, whether it is pharma sector. So there are certain sector-specific impacts that will happen, which we are being cautious about. But otherwise, on a fundamental level, there may be not that much impact apart from the export-sensitive market specifically to the US. But I think it's a very difficult feat to today understand what he's trying to do and how much of that will he do it and how the market will react, because this whole cross-border trade war is not a very easy game to manage. It's not something that you just announce on a television and you say that now implement without the repercussion of that. And I also feel that the US market slowdown, and people have already started talking about recession in the US market. I'm saying people have started talking about it. If he implements all of this, which he's aware, and if any of those kind of things that can happen, you may or may not know, but India may be the beneficiary of certain such things that can happen. So it's a very, very dynamic and fungible position. I think we should keep talking about it in our webinars. So keep giving you an update. But I think currently we should just wait and watch in terms of what actually can happen.
Okay, this next question by Pawan. Banks are not safer now, so that they are following. Their growth is very less as compared to past due to increase in competition for funds and loans. Would it not be the same low growth sector for long due to high competition? This is the reason for derating of most of the large banks. What are your views and comments on this?
So let me take this question. I think
We don't tend to disagree with you, sir, on this. I think if you look at the bank Nifty has been more stable in 2025 as compared to some of the other sectors which has really come under a lot of pressure. Now, I think we need to say that banks are safe for now as they are not following. They are to say you are not falling that much. That's what you are saying. But their growth is very less as compared to past due to increased competition of funds and loans. See, if any economy has to grow, the banks and finance has to grow. That is simple as that. Why? Because that's the liquid that basically that's a fluid that needed to run the engine of the economy, and that will do. So if you go back to some of the classical example of US, Japan, some other developed country where economic growth has been in line with what's going with the banks and finance. There is no economy which has grown without growth in the banks and finance. So I think competition will be there. Some bad people will go out of the system, and some new. So if you look at this complete banking sector, a lot of private sector banks did come. How many they have been able to successfully able to take on the competition? So it's a very, so people think what's our competition आ गया, अपन कौन है competition में? Look at what has happened. If you go back 10 years back, how many banks were there? And you look at how many banks are there today. What was the GDP 10 years back? And what is the GDP now? It has gone up or gone down? It has gone down. Number of banks in the country has gone down in last 10 years. So where is the competition? The competition comes when number of players increases. That's where the competition comes in. Am I right? And some of the banks which are there, they are much, much what we call the weaker, what we call version of what they were 10 years back. Am I right? So I think somewhere we need to understand that there will be some player will come, competition will come, but how strong that competition is. And if you look at 10 years back, what kind of market share top 5 banks had, and what is the kind of market share they have, most probably they would have a higher market share as compared to what it was at 10 years back. So I don't know there is a high competition in that sense, in a literally that's not the thing. And I don't think that's the reason why one should be derating most of the large banks. I don't think so. Definitely not. And it's a very, in fact, if you want, maybe in my next webinar, I'll give you data. 10 years back, what was the market share by top 5 banks and versus what it is now, and you will see the difference there. But I'll present the data to drive home the point.
So if you can share the screen, please, just to establish what Sunil has been saying. If you look at the current fall,
Well, the screen's not
from,
visible currently.
sorry, let me just maybe share it. Yeah.
Yeah.
If you look at the current fall,
We just
just
participants
participant
को
को
बंद
बंद
कर
कर
दो
दो
ना.
ना.
हाँ,
Yeah.
the top two that you've seen out here, which is Nifty Finance and Bank Nifty, have actually corrected the least. 8% since high of September 26th. Bank Nifty at 11%, and there's been a visible carnage across various other indices. See, please understand that when any kind of a fundamental slowdown comes, I think the second tool that to drive consumption, to drive the economy is what we need to start looking at is the monetary policy very carefully. In a high inflation, low consumption kind of a period, monetary policy becomes very, very important. And you will see RBI interventions already starting to happen. So we personally, as Sunil has already pointed out, in fact, we are on the favorite side. We can have a detailed analysis and a detailed webinar on that. But we personally feel that Nifty finance and banking, especially on the private banking side and some select few banks, may be a very, very good option to look at.
Okay, I'll pick this question by Jignesh. Mohit, what's the difference between the current offer and the stock of the week plans? Also, can we have a combo offer for the webinar attendees?
We can do that. The current offer doesn't have stock of the week. It has Mojo One. We have a stock of the week combo offer already on the site, which you can see. But webinar offer is currently limited only to 3 years of. It's a 1 year price that you're paying, but you're getting 2 years free. So for 15,999, you actually get 3 years instead of 1 year. But if you're looking at a combo offer, please write to us. We'll do something and give it to you. Otherwise, it's also available on the website. But I would strongly suggest for people who shied away from coming to the site, or you will hold on to the site after a month when the market starts recovering. This is a good time to buy at the low, as you say.
Okay, this question by Durgesh. Dear sir, we understand that the short-term outlook for IT sector is not good, but there are still some shares like Persistent and Coforge on MarketsMojo which are shown as buy. Can we buy the same or should we avoid the sector as a whole?
No, I think you should strictly follow what in fact, one of the stocks that we've also put up today is Dixon Technology. There are very segment-specific IT stocks that are looking good. I think you should strictly follow the ratings because we are very careful about what we are recommending out there. There's a lot of investors who've said that, "Arey, recommend more." So it's not a question of what quantity we recommend, but what quality we are recommending out there. We have to make sure that we stay fundamental and we stay, updated to the selective stocks that we pick and show you out there. So I think I would say that please do follow strictly the IP that is reflecting on the site.
Just to tell you, I think the persistent system is our stock of the month. We recommended
in December 2023. It has given about 57% return since that, versus the benchmark, which is up by just 7%. So 53 versus 7%, huge alpha that has been created, and we have not closed that call. It still remains a stock of the month. If you go to a stock of the month section, it continues to remain this one. So as Mohit rightly said, while the view may not be good for the sector, but some companies may do well because of its inherent strength in that company. And at appropriate time, we will advise you to exit from that persistent system also. So please follow our score. In fact, someone asked me yesterday, if you are not so bullish on mid and small cap, why did you recommend 5 mid and small cap? And we said, while overall our view may not be so great on the mid and small cap, but some companies that we believe within the mid and small cap can do well, we recommend it. The same logic applies to the IT as a sector also.
Okay, I'll pick this question by Mr. Tawan Arson. He's dropped it quite a few times. Hello, Moji. We want a webinar on the most successful product of MarketsMojo, that is the model portfolio. First, please do a detailed webinar on model portfolio. Second, as investment duration is for long term, it would be great if you can increase the investment amount up to 10 crores for each model portfolio.
Sir, you may be the only one who may be asking that. I will definitely do a very detailed webinar. Jason, make a note on model portfolio and performance. I must tell you, our model portfolios, the sad thing is, I'll tell you the really sad thing that is there. A lot of you guys have taken the package, you don't use it. It's not a question of having a suit in the best suit in the wardrobe if you don't wear it, right? So, because I know how many people typically update their model portfolios or how many people are following it. Our model portfolios run exceptionally well, I would say. And I will come back to you with the detailed presentation on that. But please follow it up because, I was actually, reading a book, which is something which is very, very interesting, in which the advisor goes to the client and says that, please give me all your net worth statements. Please tell me how much money you have. Please tell me where you've invested, and then I'll be able to tell you what you should do. The investor says, you give me your net worth statement. You tell me you are capable. You tell me what your returns are. And then I will check whether I need to invest through you or not. And which is a very, very wise thing. So if you see the performance and if you see versus what a lot of investors come and say, Mera to personal portfolio is doing rocket and this is very good and all this stuff. But trust me, you will not be able to maintain that over a longish period of time. So my request to you is strictly follow that model portfolio. If you're using it, because a lot of people have created, you not believe that I think, created some 3,500 crores of model portfolios. But in terms of acceptance ratio, in terms of people who actually follow, is very minuscule, right? So I will do that, sir. I will present to you whether we make it 10 crores or not is a different issue. But I think whether even if it is 10 lakhs or even if it is 1 lakh, the first thing that I want is for you to start using it. And not for you, Taji, but I'm talking about my other investor friends, that please start following it. Do not lose the journey. When you are in need, when you are in need of a physical attention, that's when you should listen to the doctor the most. You should not start doubting the doctor just because you fell sick. So I think that's what I will tell you, is that because I know that, how many people used to come onto the webinars to listen to us when the markets were high, and they will all come back. And then they will say, what should we do? And I have my staple set of loyal guys who are always attending. And I know that, how much you care about things. But please make sure that other people follow that model portfolio. It is doing really, really well.
सर 10 करोड़ का पोर्टफोलियो मॉडल पोर्टफोलियो साइड पे दे देंगे तो फिर पीएमएस में कौन आएगा? तो हमें बड़ा धंधा करवाना चाहते हो तो सर वी वेलकम यू इन आवर पीएमएस. प्लीज कम. I remember, sir, we spoke once. I think you're still waiting for that
model portfolio. That's the one reason you are not doesn't want to come to PMS. My request is that open invitation to you, sir. Please come and join our PMS.
He wants to manage 15 crores and 15,000 rupees.
Okay. We've actually crossed our time, but if it's fine, can I take a few more questions, Mohit?
Please take.
Sure, go ahead.
Now, this question by RB: do you think the government should do more, like streamline taxation, both direct as well as indirect, rationalize duties and tariffs, liberalize India a little more to make India stand out vis-a-vis other emerging markets, to attract not only FDI investment but to also spur the domestic economy as well? Please share your thoughts on this.
I think government is doing, if you look at the direct tax code, I think it's a
move in the right direction, removing number of laws, making language simpler. Indian Institute of Chartered Accountants also further revised, and they've given some suggestion. If you look at the GST, I think it's one of the biggest reforms one can say which has happened, because it really removed. I remember, I don't know how many, either you are from Bombay or not, but whenever I used to go to Gujarat and want to come back to Bombay, there used to be Octroi Naka near Dahisar. And invariably, I would spend half an hour at the Dahisar Naka, because there is an Octroi ka, this one. It's completely gone. The complete movement has become this one. So I think both direct and indirect, I think India has really moved a great distance in that sense. And that's one of the reasons why, despite so much global worry, India would continue to remain the fastest growing economy. Having said that, is there more scope for improvement? Answer is yes. There is nothing where no country in the world can say that I've done this, now there is no further scope for improvement. It will never happen. And I think we are moving in the right direction. I think if you read the complete budget which was presented on the first wave, I think the complete theme line is that ease of doing business. And I think government is working on that ease of doing business, whether it's an FDI, whether it's an FII. And I think spurring the local economy, the domestic economy, I think it's moving in the right direction. Only thing, the argument could be, can that pace of the changes can be a little faster? Ideally, yes. But remember, we are also living in a democratic country. Unlike some countries where they're autocratic, the things move a little faster. In democracy, you need to listen to various people. So sometimes the pace of reforms do get little this one. But I think we are moving in the right direction. So in terms of ease of doing business, direct tax code, I think it will be a game changer. Remember, the number of the section and subsection which has been removed, the language that has been improved, I think it's going to game changer. And what government is doing, just look at each one which impacts everyone. Direct tax code, the new regime, income tax. So simple. It's so simple, you don't have to worry about it. In fact, more and more people are opting for it. The government want to simplify that, and I think that is what the rationalization. And of course, once you start that process and starting, it will keep rolling year after year. So my sense is that I think we are moving in the right direction. Mohit, would you like to add something?
No, I think I'll stay with you.
Yeah.
Okay. Mohit, post you share the screen. A lot of the investors are asking that if it's available on the website, but I'll pick this question by Amit. Is that when do you see these earnings catch up for the board BSE 500 universe?
I think we are around the next result. So let's look at this quarter. We will make a lot of this information live for you guys. This was what I was showing you is my personal back end, which we look at on a day-to-day basis. There's a host of backends that we've got like this. Just to also not impress you that we do a lot, but we've started developing this not at a BSE 500, but even at a sector level, we are going to sharpen a lot of things. A lot of these features are coming up in the next 1 to 2 months, I would say. You would immediately see a new stock page, which is under process. I think in the next 2 weeks, we are taking it live. You will be able to see all the scores, last 4 scores, and what happened during those 4 scores. A lot of you people have requested that we need to see whether the score is working for this company or not. You would be able to do comparison in between various companies and between the sector. You will be able to do valuation comparisons out there. So the stock page, we've been working on it for the last 1 to 2 months, which is going live, and then we will attack the markets page and all of this, which is BSE 500. Technicals are where today. Is there any correlation with the technicals? Whether the technicals can be a lead indicator to how the fundamental results would be, whether it is a lag indicator, how the results are looking for BSE 500, all of that intelligence that I'm showing you on the back end is what we are creating so that you guys can see it in the next launch of the product. So there's a lot that is coming up. Just stay patient a little. In terms of when do we see the corporate earnings picking up, I think in the next 1 to 2 quarters, we definitely see the corporate earnings pick up. I don't know what Sunil's comment on that is, but I think towards the second and the last quarter of this year, you would see a correction, upward correction that may come in. But having said that, if you look at PE, the PE kind of adjusted for the revised earnings. So it's not that we are trading at very high P's with the fundamentals going down. There has been a sharp adjustment. Our P's over a 10-year period are looking reasonable now. So I think even if fundamentals pick up with a little bit of a lag, we should be fine at the current and the levels even above this.
I think my sense is that by June 2025, we will see this revival in the... And
I'll explain you the logic there. You look at the GST collection, that remains quite robust. You look at the inflation, 7-month low. You look at the crude oil price, our Indian basket was $80 per barrel in the month of Jan. We are closer to 70 now. That benefit will keep coming in. The budget impact is still not kicking. That 1 lakh crore rebate that has come, वो सिर्फ बजट अनाउंसमेंट है, अभी तक किसी के पास उसका बेनिफिट नहीं मिला. I think the real first benefit will come when people will start getting their paycheck in the month of April. So some will get in the end of the April, someone will get in the first week of May, whatever. The rebate would be 1 lakh crore, 8,000 crore every month. On the top of it, there are surveys which suggest that India Inc. will give near about 9.4% salary hike in this, the financial year FY 2026. So when you combine both, there is a quite possibility that you will see this consumption cycle making a comeback. The capex, the last year we had an election. So the first quarter was completely washed out. Why? Because of election, the giving what we call tender and giving this one orders were basically lackluster. We don't have anything kind of stuff, in fact. So when you compare that, even this should be better. First quarter, there was severe heat wave. Of course, we don't know what would happen because yes, in city like Bombay, we do have a very bad weather now. But because of the, a lot of people, if you remember, my commentary was that people did not come to the store, people did not move out because of heat wave. And that did also impact the movement of goods and services. It did impact the sales and other things. Fortunately, most probably that may not be there. So I think there are various factors which looks very positive as compared to what it was the same period last year. That is, I'm talking about April to June quarter. And that's the reason I believe that we should see a revival happening in April to June 2025 quarter. So that's where we would see some, even the commentary will become more and more what we call comforting. People may not talk about margin cut, people may not talk about top line growth challenge and so on and so forth. I think that's what I strongly believe.
Okay, moving to this next question by one of the investors. USA government is reeling under huge debt. How serious this matter is from the stock market point of view?
So you are right.
US has a problem, not now, but it has been there for quite some time. Right now we don't believe that it's a concern for the US or for the world market. Why? Because there is no competing other countries which can basically replace US dollar. So whenever they need money, people are going to, because that's also like a reserve currency. Unless there is a de-dollarization that happens in the world, and of course, some indication are that people are basically forming a block kind of a stuff. On one side, you have a US, and other side, the likes of Euro area, the likes of Canada, China, maybe India, kind of a joining hands, and so on and so forth. Right now, it's not a concern, if you ask me very frankly. Can it be a concern 3 years, 4 years, 5 years down the line? Maybe yes. If you look at what Trump is talking about, Trump is also talking about, reducing certain expenses, which how much is successful, we don't know. But somehow if he's able to do that, I think it will also help him to reduce the borrowing. So I think that's a concern, not an immediate concern. Let me put it this way. Yes, it could be a problem 3 years, 5 years down the line, but not immediately.
Okay, this question by one of the investors. Since both of you are on this webinar, any plans to start something on the lines of PMS but with the lower ticket size based on the SEBI launch of Specialized Investment Fund?
Yeah, there is a plan. Wait
Okay.
for 2 weeks.
So Mohit has something, but let me clarify. Specialized investment fund is not allowed to the PMS. It's only allowed to the AMC. That's an assets management company. So we will not be able to launch specialized investment fund, but I think Mohit has some plan that Mohit will come and discuss with you in future. But yes, we do have some plan on that line.
Now, we have a investment advisory license, which lets us do portfolio approaches, just the way that we had Infinity. We have some plans in the very final stage. So you should be seeing them live as early as 1st of April. So yes, we are doing that, where the smaller than 50 lakh investors can benefit from the same service.
Okay, so that's it with the Q&A session for today.
All right, good night and wish you all a happy Holi in advance. Please wish everybody from our side and your family. May your life be full of colors. As I said, the red one should come off as soon as possible, but the green color should be there on your face for a little while. Wish you all a very happy Holi.
Thanks a lot. Wish you happy Holi, and let's hope that by next time when we come, we are more greener than the red actually. So good night, take care.